Bank of America is launching a new program to address racial disparities in home ownership.
Hey everybody, Dietric Williams, realtor with Compass, Baldwin Hills, California. Welcome back to another edition of Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate the easy way. If that sounds like something that you're interested in, please make sure you hit that subscribe button and ring that bell so that you're notified every time I upload new content to YouTube. Now, earlier this week, Bank of America announced a new program that's targeted for first-time home buyers who are looking to buy in predominantly Black or African American, Hispanic / Latino communities. The Community Affordable Loan Solution is aimed to help individuals and families acquire an affordable loan to help them purchase a home. Now, there's zero down payment, zero closing costs, and no mortgage insurance. Applicants for this product do not have to be Black or Hispanic in order to take advantage of it, but they do have to buy in predominantly Black and or Hispanic neighborhoods. And it's currently only available in 5 cities: Dallas, Detroit, Charlotte, Los Angeles, and Miami. One of the stipulations with the program is that home buyers must complete a home buyer certification class, which is selected by Bank of America, and it has to be HUD approved. Now, one of the great things about this program is that there's no minimum credit score requirement, and eligibility kind of depends on certain factors such as timely payments of rent, phone bills, utility bills, auto insurance, things like that. There's also an income limit requirement, and I'll get into that later. And it also depends on the home's location. Now, B of A will also be supplying down payment grants between $10,000 and $15,000. And I believe those grants vary from select cities. So you're gonna wanna talk to a B of A representative in your city just to find out what those limits are. There's not a lot of information about the program. And as you can imagine, I've been getting calls, texts, emails pretty much for the entire week, asking me my opinion and what I know or what I think about the program. And again, there's not a lot of information out there. So I'm all about that. I reached out to a couple of B of A lenders just to get some specific questions answered. Now, I'm gonna share this with you, but you have to take it with a grain of salt because this is specifically for Los Angeles. You're gonna have to check if you live in one of those other 4 cities, you're gonna have to check with the B of A representative to see how this shakes out in your area. But here's what I found out. The max debt to income ratio, and if you don't know what that means, I'm gonna leave a link to one of the videos I did before about that up there. But DTI, or debt to income ratio, is your debt divided by your income. That ratio should not be higher than 50% in order for you to qualify for this program. If it's over that, you probably won't qualify. The lower it is, the better your chances are to get qualified for this specific product. Income limits are going to vary, and again, this is just for Los Angeles. So when I spoke to the B of A rep, they told me that the income limit is 150% of the area's median income. Now, when you're looking at Los Angeles, the median income here is $91,000. So $91,000, keep that in mind. 150% of that is $136,500. So that's the income limit for Los Angeles. Now, here's where things got a little bit sketchy in terms of what I was asking, because it says zero closing costs. But when I spoke to the rep, they told me that the bank will cover all closing costs except for discount points and prepaid items. Prepaid items are typically things like homeowners insurance, property taxes, and mortgage insurance. But you're not gonna have mortgage insurance with this product, so that won't matter. So again, you're just gonna wanna talk to your rep wherever you're at to find out if this still holds true for your area. And remember when I said that grants are between $10,000 and $20,000? Well, for Los Angeles, the max grant you can get is $15,000. If you've been watching this swirl around through social media, everybody kind of has their opinion on what this could be because, let's face it, Bank of America, Wells Fargo, Chase, all those big banks have a really checkered history as it pertains to lending to people of color and people in communities of color. So this is more kind of to right the wrongs or the sins of the father, I guess you could say. With that said, a lot of people have been saying that interest rates on these loans are going to be way higher than what market rate is. I was told by my rep that interest rates are going to align with market rate. So whatever today's prevailing rate is, or that day's prevailing rate is at the time you qualify for this mortgage, that's what you're going to get. Now, they did also tell me that higher FICO scores will help decrease that interest rate, just like with any other type of loan. The higher your FICO, the less of a risk you are, the better your interest rate is going to be. And then I ask about underwriting. Now, for some of you, you're not really going to understand this. You won't know what I'm talking about. But underwriting is all that information that you send to the lender. They either check it manually or they put it in the computer, and whichever one, they're going to say whether you qualify or not. In some locations, I believe that the underwriting for this program is automated. So AUS, automated underwriting system. But here in Los Angeles, I was told it's going to be manual. So there's going to be somebody who sits down and actually crunches out the numbers, as opposed to it being input into a computer program and the program spitting out whether you qualify or not. I also asked another question, because with DPA programs, sometimes there are time limits and you get penalized on these time limits. And what I mean by that is, for instance, some DPA programs will say you have to live in the house for 3 years before you can sell, refinance, or it's no longer your primary residence. If you do any of those things before the 3-year period, they ask for whatever money they gave you in assistance, they ask for it back. Also, some of these come with equity shares, and I touched on those in another video. I'll leave that link as well. But in equity sharing, when you go to sell, that program will take a portion, or whatever's agreed upon, a portion of the equity that's built, and it can range anywhere between 10 and maybe 25%. Now, here's something that most people don't actually know to ask, but I asked, were there any reserve requirements? And here's what I was told. For an individual who has a 12-month rental history, that they can show that they've rented for 12 months, no lates, no anything like that, and they're going to purchase a 1-unit home, meaning a single family residence, so condo or a house that only single family can live in, that there are no reserve requirements. However, if a borrower who has that same rental history, 12-month rental history, if they are purchasing units or multifamily, so anything between 2 and 4 units, then they have to show 2 months of reserve requirements. Now, any applicant who doesn't have a 12-month payment history in terms of rent, they are going to have a reserve requirement. And if they're purchasing a single family home or a 1-unit home, they're going to need 3 months of reserve requirements. That same applicant, if they're looking to go get units, is going to need 6 months reserve requirements. So you just want to keep that in mind. Now, as we're talking about multifamily, if you're planning on using this program to pick up multifamily property, you will have to put down 5%. So that's a major difference. Again, check in each state or each city that you're going to look in this program and see if that still applies, because I'm only speaking about what I learned about here in Los Angeles. Now, this is all the information that I've learned so far. Again, you're going to want to talk to a B of A representative in the city that you're in to find out what exactly is happening in that specific location. I will say this. The program sounds similar to NACA, and I did a video on that one. I'll also leave that up there, so go watch that one, where NACA does no closing costs, no down payment, no PMI, the list goes on. One of the main differences though is that with NACA, they require you to volunteer while you live in the house at certain events. And then there's also that piece where I told you that there's penalties if you decide to refi or move out before a certain period. In NACA's case, it's like 5 years. So if you stay in the house 5 years, you don't have to prepay. If you move before that, you're gonna have to give that money back. And that's one of the differences, at least for now. That's what I'm understanding. But this does help a lot of people get their foot in the door who may have been trying to purchase a home and weren't afforded the opportunities to do so, or they just needed a little help to really get over the hump. Here's a tremendous opportunity for them to take advantage of. Now, with anything free money, you know the saying, it's not always free. There's probably some fine print. There's probably a catch here or there. I don't know what those things are because I haven't looked through it with a fine tooth comb. But again, just keep that stuff in mind. And as it relates to NACA, Again, very similar sounding programs, but it looks like B of A may be trying to eliminate the middleman on something down the line. I don't know. In fact, I think NACA's partnership with B of A is supposed to end in 2027. So who knows? What's interesting is just before this announcement hit on Tuesday, I was telling somebody that, lenders are having a hard time right now because there's less people applying for mortgages and the refinance game is dried up. I mean, who's going to want to refinance to a 6% loan unless you have like 8% or higher? Most people already refied in the past 2 or 3 years, so that game is dried up. So I think that's forced a lot of lenders to look at other ways outside of the box that they can kind of spur some of that demand in terms of applying for mortgages so that they can keep their businesses afloat. So I wouldn't be surprised if you saw other banks or lenders come with very similar types of products and try to unroll those to keep businesses afloat. Otherwise, they got to cut overhead. And I'm pretty sure you've seen they've had layoffs at different lending institutions. And if this thing doesn't get under control, it's probably going to continue. So I think this is a way to kind of stave that off. So we'll see what happens. Nevertheless, check it out for yourself. And if you're looking for information on other types of down payment assistance programs, you're going to want to check out these videos I did right here.